Today we are going to tell you some lesson about accounting. Well, we're from group 3 gonna explain intermediate accounting course which specific on paid up capital. So what is paid up capital and what kind of paid up capital is this section? So for the details you can watch our movies, our story, and we're gonna make this explanation is still fun and make your stay at home activity become more productive. So let's check it out. An individual company. An individual company is a business entity whose ownership is owned by one person. Individuals can create individual business entities without specific permission and procedures. Everyone is free to make a personal business without any restriction to set it up. In general, individual companies have small capital, limited type and quantities of production, have small workforce or labor, and use of simple technology, production equipment.
3. Limited liability company. Limited liability company is a business entity in the form of a legal entity that is established based on an agreement and conducts business activities with authorized capital, which is entirely divided into shares or also referred to as a capital alliance. It is possible to change the organization or ownership of the company without having to dissolve and re-establish the company. There are two types of VT, namely a closed VT is a company that does not issue shares to the public and shareholders are only based on certain circles. B. VT often is a company that uses shares in the capital market so that the public can buy it. Individual company CP versus VT. If an individual company or a CV suffers a loss, the company owner may be held responsible for both his funds and personal wealth.
Issuance without nominal value. In some countries, shares can be issued without face value on the grounds that number 1. Companies avoid contingent liabilities. Number 2. Companies and investors avoid the confusion between recording the nominal value or fair market value. Issuance with other securities. There are times when companies issue shares together with securities issuance. Like this is done to increase the attractiveness of company shares so that many investors are willing to invest in the company. Issuance with services or non-cash. Stock may also be issued for services received as payment for legal or consulting services or for non-cash payments such as land acquisitions, buildings, and equipment. B. Preferred stock. Preferred stock is a stock that has the characteristic of a combination of bonds and ordinary shares because it can generate fixed income such as bond interest. This is due to getting dividend distribution right permanently.
Equity of limited operation. 1. Fate of capital is capital that has been included by shareholder as payment for the payment of share taken as capital placed on the authorized capital of the company. So, fate of capital is share that have been paid in full by the holder or owner. In the case of ownership based on share that are to share used by VT, namely E. Common stock represent residual company ownership. Each share used is a representation of paid of capital and the amount of paid of capital is not the same as the authorized capital. There are four types of ordinary share that a company can use. Issued with nominal value, share can be used with the certain nominal value per share. They are generally lower than the initial stock price in order to avoid further contingent liabilities.
The distribution of period stock dividends. 1. Cumulative individual is the distribution of dividends for a period before that dividend of the previous period that are not distribution. 2. Participator individual is a dividend policy for a period that produce dividends after that shareholder can obtain dividend allocation in the same percentage dividends. And then 3. Retained earnings. Retained earnings is net income not shared by the company that shoulder in the form of dividends. Retained earnings are only equity organization from the accumulative of net income of the company that is not returned or distributed to owners or shareholders. The last 4. Another compressive income. Compressive income is a account that effective that value of the company's equity that is not directly